Hello and welcome. And this lecture video starts on page 209, and it covers disposal of receivables and also our accounts receivable turnover ratio. Okay, so let's talk about disposal of receivables right over here. So what we're saying is that companies can convert their receivables into cash before they get paid, before they're due. Why would they want to do this? Well, remember, you can't pay your employees in receivables. You have to pay your employees in cash. So they could need cash right away. And they may just not want to deal with the hassles of collecting on the receivables. Okay? So there's two different ways that they can do this. They can sell their accounts receivables, which is also known as factoring. Or what they could do is to pledge those receivables as collateral for a loan. And so let's talk about those two different scenarios. So the first one, when they sell the receivables, they could sell a portion of all or some of their receivables. They could sell all or a portion of the receivables to another finance company. That company would be a factor, and so selling the receivables is called factoring. And so, like we've talked about before, there's no such thing as a free lunch. If you sell your receivables, you're going to have an expense for doing so. So when they sell the receivables, they have to pay a factoring fee expense. And so maybe that factoring fee expense is 1% of the receivables that they sell, or 2%, or whatever the percentage is. So when we look at this example, when TechCom sells $20,000 of its accounts receivable and is charged a 4% factoring fee, here would be our journal entry. We would debit cash for 96% of the $20,000, right? And then we would debit our factoring fee expense for 4% of that $20,000. So we would debit cash $19,200, debit factoring fee expense $800, and then we would credit our accounts receivable for $20,000, okay? That would be the journal entry when we sell these receivables. And again, why would a company want to do this? Well, they may need cash quickly. They also may not want to deal with the hassle of collecting on the receivables, so they outsource it to another company. But you have to pay for that, right? So that's that factoring fee expense. And so you're not going to get all your receivables that you sell in cash. You'll get a percentage of those in cash, and then a percentage goes to your factoring fee. And of course, this factoring fee expense would be another expense on the income statement. And I'll write that down. Income statement, that would show up on the income statement. Okay? And so that would, of course, lower net income. Another option for a company is to pledge its receivables as collateral for a loan. Okay? They could pledge those receivables as collateral or security for a loan. Okay? So in terms of that journal entry, and what we say, let me look at this last bullet before I talk about that journal entry. It says, this is a good point, if the borrower defaults on the loan, the lender then can get cash receipts from those receivables when they're collected. So that's what we mean by you take out a loan, you pledge those receivables as collateral. If you default on the loan, then the person that lent you money now has a right to those receivables when they're paid. Okay? So if we look at this example, when TechCom borrows $35,000 and pledges its receivables as security, here's how it would record the transaction. So basically, they're just taking out a loan. And TechCom should disclose that some of its receivables and what dollar amount of its receivables are collateral or have been pledged as security for a loan. They should disclose that, okay? So in this case, when they take out a loan, it's just debit cash and then credit their liability notes payable. So here on the next page, we have a quick check problem. So why don't you go ahead and do this one, pause the lecture video and do this quick check problem, and then come back and check it, okay? So here we go, number 72. The company factored $45,000 of its accounts receivable and was charged a 3% factoring fee. The journal entry would include what? So we debit cash for 97% of the $45,000, so debit to cash for $43,650. A debit to factoring fee expense for 3% of the $45,000, so $13,550. And then a credit to accounts receivable to recognize that we no longer have that accounts receivable of $45,000. So C is the correct answer. Okay, so let's talk about the last topic here in Chapter 9, which is a ratio accounts receivable turnover. It provides good information for how efficient management is in granting credit to produce revenue. So how quickly do we collect on our accounts receivable? Okay, so it's how quickly do we collect on our accounts receivable? And the way that we calculate this is we take our net sales divided by our average accounts receivable. So how do we calculate the average accounts receivable? We've talked about this in some prior lecture videos with other ratios. We take our beginning accounts receivable, so at the beginning of the year, plus accounts receivable at the end of the year, and we divide by 2. That gives our average. And so then we take our net sales, or net credit sales, divided by our average accounts receivable. Okay, and then that gives us our accounts receivable turnover, and this is a good measure of how quickly we're collecting on our accounts receivable. Okay, so when we look at what does a high turnover mean or a low turnover in terms of industry norms, so a high turnover ratio means that management might want to think about making their credit terms a little bit easier. A high turnover is going to be more favorable to a low turnover, all things being equal. But if it's too high, that means maybe your credit terms are too strict. And so if you loosened up your credit terms a little bit, you might be able to increase sales. That's what we're saying when the turnover ratio is really high. But if I were running a company, I'd rather have it high than low, because low means that your credit terms are too loosey-goosey and you're going to have to really step up your collection efforts, right? And so you don't want to have to go down that path. All right, so let's take a look at these quick check problems right over here. Number 75, accounts receivable turnover is calculated by A, we just talked about that, dividing by our net. Our best would be, here it says net sales, but the best option would be really net credit sales. So net credit sales divided by average accounts receivable. And then number 76 right over here, our company has net sales of $900,000, average accounts receivable of $300,000. So we take our net credit sales divided by our average accounts receivable, and that gives us 3. E is the right answer, okay? Is this good? Is this bad? It's hard to say because we don't know what the other companies in our industry are doing. We'd want to compare that against prior years, and we would also want to compare that against other companies in our same industry to determine whether that's a good or bad ratio, okay? All right, well, that concludes our Chapter 9 lecture notes. Thank you so much.